Welcome back to the show, everyone, the Capital Compounder Show. Today we have a very special guest. His name is Ardal Loh-Gronager. He's the founder and managing partner of Loh-Gronager Partners. Ardal, welcome to the show.
Thank you so much for having me, Robert.
So you were an entrepreneur very early on. I think in the schoolyard in elementary school, middle school, you were trading video games basically, right? So you something sparked that in you early days.
Yeah, there was definitely something there. So I was seven, and it was quite just organic, right? Because no one could afford to have all the different games consoles. So I had a Nintendo 64. I had a friend that had a PlayStation. I had another friend that would have a Nintendo 64. But I don't know whether anyone remembers these consoles. But the games were half the price of the actual console.
Yeah.
So you sort of got one game for your birthday and one game for Christmas if you were lucky. But there were new games coming out all the time. So there was definitely a demand there to sort of have each or play each other's games. So my idea there was with the console club, when I had a friend for a sleepover, I was like, wait a second, rather than inviting you over and then borrowing your games while you're over, I want to play them when you're not here too. So that was the genesis of a really
That's
simple
awesome.
business idea, which was that we would then trade those games between us.
So it wasn't enough, Ardal, for you just to enjoy Mario Kart, right? You wanted to trade and make some money here and there, right? What was your favorite game for the N64? I had a friend with the N64. I'd go over to his house to play. I was the guy with the PlayStation, but I would love to know what your top.
I can't believe you're getting this out of me in public, but I'd say James Bond GoldenEye was my favorite.
Oh, GoldenEye 007. I remember all the parties, yeah, playing that game. Just wonderful. The theme music, just top notch. Okay, this is awesome. So, and your parents obviously were entrepreneurs. They're business people. They're running their own businesses. So around the dinner table, you're always exposed to all of that. But like, what was that exposure like early on, and how did that even further spark your interest in doing something on your own later on?
Well, I think there were two sides to it. So one was exactly what you said there in the question, which was I was kind of surrounded by it.
Yeah.
So when I was growing up, we lived in 11 different houses when I was growing up, because my parents even saw the houses we lived in as like an entrepreneurial activity. Buy one that requires work, do it up, and then sell it, and then move to the next one. So our houses were always building sites. So I guess there was that side of it. And there was also the fact that my parents were trying to start businesses on the side. And that would be the sort of dinner time table conversation would be, what's the idea? How are we moving forward with it? And there's just one business that always sticks in my mind, which was in the early days of eBay, they tried to start a business called Scent Item, which was to sell perfume online. I still think it's quite a clever name, even today. And basically, I remember as a kid being taken to trade fairs where there were all these stalls set out, and you would go and meet the individual distributor for each perfume. And then
Yep.
it's quite impressionable, as a young kid, to see that stuff, that sort of thing around you. And then I think as a sponge, you kind of absorb that as an energy. And there's plus sides and downsides to it, because there were times where when I was growing up, my parents, we seemed to have quite a lot. And then there were also the inevitable downsides where, for example, one time when one of my father's businesses went under, and my parents were really struggling to pay my school fees. So I've seen both sides to it. And I think that shapes you as an individual, especially at a very young age.
Yeah. And I've read that throughout university you were kind of just really itching just to get out, just acquire the degree and set out on your own. I think that just goes back to your entrepreneurial kind of spirit, right? You just wanted to get it done and over with.
Yeah, I mean, it's funny. I think some people see university as a logical extension from high school, whereas for me, I just didn't see that at all.
Yeah.
I really didn't want to go. I was kind of convinced that by my parents and the other sort of mentors that I had that said, you really have to go. It shows dedication to a pursuit for 3 years. It shows independence from family, but study something that's of interest to you. So that's why I studied accounting and finance. But I was notorious for the fact that I would read all the course books in advance. So, for example, when I rocked up to university, I barely went to any lectures because it was all available online and I'd already read the course book. And that then gave me the free time to be working on my businesses on the side. So again, there was just a natural tendency to wanting to do the things that I was interested in, which is, a little bit of a contrarian streak, I'd say.
Yeah, absolutely. Okay, and then you started, I think, investing in the stock market, dipping your toe in 2009, which is the aftermath of the great financial crisis, which wasn't just a U.S. phenomena, also UK and the entire world, basically. And naturally, I think you were self-described at that time, value hunter, because of all the deals. But tell us some of the early companies you started investing in, and what were some of the strategies you tried implementing that didn't work, and how did you eventually land on how you invest today?
Yeah, it's a great question. It takes me on the whole journey. I'd say I was a late bloomer when it comes to investing in stocks. Some people have stories. I bought my first stock at 5, and I just don't have that. I was always more interested in businesses. So when I got gifts of money for birthday or Christmas, I'd always go and start a business with it or buy something that I could sell. So my first exposure to the stock market was my father's pension. So I was about 10 years old, and my dad said, "Hey, Ardal, why don't you help me choose the funds or stocks that we choose for my pension? And by the way, we've got a 30-year investment time horizon." And I think, therefore, I was immediately long-term from the beginning, because from the age, I didn't understand that you could do something called day trading. I thought that you bought stocks or funds and you held them for extended periods of time for when you retire. So I guess that was already my sort of ethos and mentality. That didn't stop me, though, trying everything else, like you alluded to, when I was at university. So when I was at university, I tried everything from trading options on the VIX, which is the volatility exchange. I traded commodities. I tried to do FX. I tried to day trade stocks. And absolutely nothing worked consistently for me, as well as I found, which was the positions that I bought in businesses I understood and held them. They were the only positions that I consistently made money on. And I think that I was very good at trying everything. So I'm a big believer that you should try everything and go wide to find out what your curiosity is drawn towards. But then when you find that, you need to go really deep. So I think it was during that experience of losing money on pretty much everything I tried, and then finding the one thing where I seemed to not lose money, and I was like, maybe this is for me. And that's when you double down, you do the reading and the background, and I just found that I was incredibly drawn towards that long-term value investing style.
Mm-hmm. And
And
we
that's
will
why,
get
as you said
into
there,
more of that in your philosophy and strategy. But between graduating from university and then starting your own firm, you worked at, I think, several companies, and these are big global blue chip companies. What was that experience like for you, and what was the most valuable experience out of all of them?
yeah, so I think when you start at university, I think we all have this shared drive that at the end of it, we'd like to have a good job to go on to. And despite the fact that, I was entrepreneurial and starting businesses along the way, from all the research and reading that I'd done, I'd kind of seen that it's very unusual to start a fund in university and then just continue on that trajectory. There's exceptions to every rule, so there are people that have done that. But I thought that there was more to the investing landscape that I could learn. And so for me, I just divided it very broadly into macroeconomics and microeconomics. So I joined Morgan Stanley initially in a macroeconomic role, I would describe. So I was trading interest rates. So analyzing global capital trends and broad macroeconomic flows and their impact on interest rates. And I was thrown in at the deep end because we were trading peripheral government bonds during the European sovereign debt crisis. So we're talking like Greece here. So really it trades like a credit product because it trades on a spread to Germany. So that was a really formative experience. And then from there, I got an offer to work for Credit Suisse. And that was on the microeconomic side of the business because that was to trade corporate credit. So the debt of banks. Mm-hmm. So therefore, I found that by doing both of those roles, I then had a much better understanding of macroeconomics and microeconomics as it actually impacts businesses and how it affects the global economy versus the textbook example that you get when you're at university or when you're studying. So for me, it was all about learning. But I always, even before I took my first job, I had a goal that within 10 years, I wanted to start my own fund. I didn't know what fund it would be or what I would be doing. Because I felt that was all part of the journey. But I was really focused on just learning as much as I could from all of those around me during that period of time.
Mm-hmm. That's just awesome. And I've heard from other investors who say that their experience as a credit analyst, there's very few, have helped them so much as an equity analyst and a portfolio manager later on. It's just so important. Let's talk about how you formed your partnership here, Loh-Gronager Partners. I assume it started off as and family and friends. But how did you start circulating the idea? Did you have almost like a perspective sheet and everything? Like what was the early days to get people interested?
Yeah, so I think Robin, it's like the starting of all businesses. It's messy, is how I describe it. So I had this idea even before I started working at the banks, and I finished working at Credit Suisse, and I thought. I've been doing, to backtrack slightly, whatever product you're working on within a bank, you can't invest in that with your own money. So when I was trading bonds, whether they're corporate bonds or government bonds, the only thing I could invest in was equities, and you have to own them for a minimum of 30 days. So that for me was no issue at all. But it essentially meant that I was a long-term concentrated value investor for the entire roughly 10 years that I was working in banking, and developing that mindset and that ethos and how to source these ideas and hold long-term compounders. So that was my background. And then when I left Credit Suisse, I was making more money from my personal portfolio than I was earning in compensation working at the bank. So that was the main driver. I wanted independence, and I wanted to essentially work for myself. Mm-hmm. And at the same time, there was a family office based in the UK, which I was informally advising. It was a friend of mine for a very long time. And essentially, this was sort of around the COVID period, and the idea was floated to me that potentially they could come on board as an anchor investor in a fund if I was to launch one. So that to me sounded like a good idea as an entrepreneur. I was like, great, so I've found what I want to do. So they promised a capital commitment, and it took roughly 16 months to get all the authorizations, the business set up, or the office where you see where I'm sitting here today, the team gathered together. And obviously that was, we were meant to launch on the 1st of January 2022. So those of us with a memory will know that that was basically the market peak. Yeah. 2022 was the post-COVID bear market. Yep. So luckily we didn't launch on the 1st of January. We actually launched in October of that year, towards the end of October, start of November. So the market had fallen roughly almost 30% by that point. So it's the perfect opportunity to buy as a value investor. Unfortunately, though, our anchor investor didn't come through with their commitment. So we launched the business with $8 million, which was only from the management team. So we launched with no external investors, which actually in hindsight has worked incredibly well. Because what that allowed us to do is it showed that we, the management team, had conviction in the business and the stocks we were buying at the time. But it also shows that we were willing to put our own money at risk in terms of trying the systems, policies, and procedures of executing trades, finding brokers, custodians in exotic markets like Turkey or India, just with our own money. And obviously, if we made mistakes, it would only cost us. So that when we then opened to external investors the following year in 2023, we knew that we weren't going to make any simple mistakes that would set us back.
That's just phenomenal. And that builds trust with external investors. And I think even more is your fee structure, which in this day and age, your fee structure might seem very unique, but you based it on, the greatest investor of all time and his early partnership. So tell us about your fee structure.
Yeah, so I'm a big believer that almost everything in life is built upon, that's great, is built upon the shoulders of those giants that went before us. And I just found it extraordinary when I read the Buffett biography. So like The Snowball by Alice Schroeder is one of my favorite books. That the most successful investor of all time, anybody, even if they're not to do with investing, knows who Warren Buffett is. But yet almost no one clones or copies or imitates the original structure of the Buffett partnerships that he ran before Berkshire Hathaway. And I think that's because most people don't know that he ran essentially a hedge fund or hedge fund vehicles before starting Berkshire, and had one of the most phenomenal track records of any hedge fund manager ever. And yet, despite that, no one copies the structure. And I find that bizarre. So yep. It was totally natural to me that we wouldn't charge a traditional management fee, that we would only charge a performance fee, and that we'd have all our liquid assets invested in the fund. Because how else could we ever look an external investor in the eye and say, we're doing the right thing by you? Yep. Because I always think whenever we make a decision in our business, a big one or a small one, we always think, well, what would the person on the other side of the table think if we made this decision? Would I invest if the other person did this? And the truth of the matter is, if someone charges me a management fee, I'm not interested in investing. If the person is taking egregious expenses, I'm not interested. If they don't have enough of their own net worth invested, again, I'm not interested. Mm-hmm. Because if the product you're offering is so good, the performance should be enough to pay for you, and equally well, you should be willing to mortgage everything you have to invest in that business or that fund because you believe it's the best investment there is.
That's just wonderful, and it's completely merit-based, as you've said, and it's based on what Buffett started with, and he's done quite well. So let's talk about your investment strategy. Let's hone into the global fund, because I really want to understand, I'm sure viewers do, like how you invest and what you invest in. So if we can talk about that.
Absolutely. So essentially, we have one fund. So very much the same as the Buffett partnerships, he had one product. And Warren, within his Buffett partnerships, had allocations within it for different strategies. And essentially, we've done the same. So we have two strategies within our global fund. Mm-hmm. So we have the developed markets equities portfolio, and we have an emerging markets equities portfolio. And we have roughly 10 full positions in each. And then underneath that, so I call them sort of the playing team. And then beneath them, we have roughly between 5 and 10, 1% of AUM positions, which we call our watch list positions. So they're kind of like the bench warmers. They're the businesses we've identified that we might think they're a bit expensive, or we might think that they're not quite profitable enough yet, or they just haven't hit all the hurdles to be in the full playing team. And the reason why we divide the portfolio between developed markets and emerging markets is that all the academic research shows that on a less than 5-year time horizon, there's not really very much correlation. So you might have a year where half your portfolio does very well and the other half doesn't do so well. But over an extended period of time, so 5 or more years, the correlation is much stronger. So what we think there is we can rebalance between those two strategies over time and add additional returns to our investors by doing that. And the flip side of that also is it encourages geographic diversification, which in today's world I think is incredibly important. And it also encourages that global viewpoint, which I also think is incredibly important, because even if you constrain yourself to investing in businesses in one country, generally those businesses operate in far more jurisdictions than that single country. Yep. So we find that by investing in businesses globally, we understand those countries that other businesses might operate in a little bit better.
So looking at the next 5 years, do you see more value opportunities in the developed markets or the emerging markets if you look at 5 years?
Yeah, I think that's a really nuanced question. So for our portfolio in particular, we have had stronger performance in the emerging market side of our portfolio since inception than the developed market side. And I think people find that quite interesting because obviously developed markets are actually the things that we read about all the time have done so well over the last 2 to 3 years. So on that basis, we find within our portfolio, we actually think there's some better value in our developed markets holdings. Only because if you look into or you drill into developed markets, it's generally been US led in terms of gains. And within those gains, it's really been the Mag 7. So if you're owning businesses outside of those, I still think there are a lot of undervalued businesses even within developed markets. That being said, though, that's specific to our portfolio. I think this year, emerging markets have shown a lot of potential investment opportunities. I think if someone describes a market as uninvestable, it immediately attracts our attention. So, for example, there was a lot of chatter last year about China being uninvestable. I spent almost 6 weeks in China last year traveling around, looking at current investments and potential investments there. This year, I think Turkey would be a good example where the political situation or instability in Turkey has had a knock-on effect on Turkey's general equity markets, where they've fallen dramatically. And actually, I spent 2.5 weeks in Turkey last year and 2 weeks there the year prior to that as well. And I think that there are good opportunities within that market as well. So I think what we look for is if we're bottoms-up stock pickers, but if we identify top-down an area of the global economy where people are afraid of, it normally draws our attention as somewhere to look a little bit more closely.
I love it. Let's unpack your framework from discovery all the way through to capital allocation. Putting capital into the idea. Can you pick? Let's work on the developed market side. Can you pick a recent or maybe 3 years, a couple of years ago, company, and just walk us through basically how you invested and why?
Sure. So in general, we don't discuss current market holdings. So I'll talk about a historic example.
Okay.
So I think within each segment of the portfolio, we're also looking for a dispersion in terms of the business type. So the company I'll talk about then is Credit Acceptance Corporation from the developed market side of the portfolio. Mm-hmm. So for value investors, it's a relatively well-known business. Essentially, they provide financing to dealerships for people to get auto financing, particularly in the US, for cars. Their particular end of the market is essentially what you might describe as subprime. So it's the more constrained purchaser of vehicles. So the reason why we were drawn to the business was predominantly due to the fundamentals underlying the business. So it operates in a niche market where it has the largest market share. It has pricing power. And essentially, it has economies of scale because the more lenders that it provides financing to, the more data it has, the better decision-making it can make. And it has a twist on its business model whereby the dealership actually has to retain some of the loans that are given. So that incentivizes the dealer not just to give loans to everybody, and to only give it to people that they believe can afford to pay it back. So predominantly, it's in general terms, it's a very stable business with a good long-term growth trajectory. And what are we looking for? We're looking for long-term owner-operating management. So we're looking for management that's incentivized within the business. And we found that at Credit Acceptance, where management hold a significant shareholding within the business. Good capital allocators, so long-term in terms of where they're allocating that capital. And Credit Acceptance will be an example of a business that does buybacks as well as dividends. When they have excess capital, they don't just sit on it. So, from a couple of different perspectives, it ticks our boxes. But interestingly, I would describe Credit Acceptance as a mistake for us.
Okay.
And the mistake we made was the fact that although it ticks all the boxes for us, or the majority of boxes, as a good investment, it's not a good business. So what we like to look for really in it, which we've learned over time, is we want businesses that the client is happy, i.e. the customer is happy, that the people managing the business are happy, i.e. the employees are happy, well, including the management team, and that we as the shareholder are happy. So there's sort of it's almost like a circular cycle there where everybody is benefiting. And what you don't have there is you don't have that with Credit Acceptance. Because essentially what you could argue is they're slightly doing what could be described as predatory lending, because they're lending to people that can't necessarily afford the vehicle. Yes, they might need the vehicle for everyday transport to and from work or to and from the shops, but there are obviously normally alternative modes of transport to that. So in hindsight, that was our main error with it. And it comes full circle back to our investment thesis. So when we have a 5-step investment process. So the first is circle of competence. Can I understand the business? Credit Acceptance is a relatively straightforward business model, so it ticks that box. The next step then is the quantitative and qualitative analysis. So we have a 250-question internal checklist, and Credit Acceptance scored incredibly high on that checklist. But I think it was missing the nuance there, which is what we've added now into the checklist, which is there a virtuous cycle within the business? And I think there's a couple of questions there I've added to the checklist. So one is, would I be proud if my son or daughter was the CEO of this business? And actually, Credit Acceptance is an interesting one, because I was looking at that question. I was like, you know what? I think out of all the portfolio businesses we have, that's the one I would say no. And it kind of loops quite well into the sell decision. So, once you own a business, we talk a lot about why and how do you come to buy a business, but I don't think we talk very much about selling. So for us, we only sell for 3 different reasons. We sell, one is if our investment thesis has been proved wrong, which it wasn't. In the case of Credit Acceptance, it was doing very well. The second one would be if the value of the business relative to our estimate of the business's intrinsic value had risen so high that it was so overpriced that we would sell. Again, that wasn't the case. It was chugging along quite nicely. So it was actually the third reason, which is we found an alternative business that was better than Credit Acceptance in every single way. And by that, I mean we'd identified a business that ticked all of our investment criteria, but also had a virtuous cycle to it.
Are you able to name that current holding? It's probably not, because it's current holding, right?
So that is a current holding. So I'll stave off on.
Got it.
Sideline that question.
This is really,
but we came out of
interesting.
Credit Acceptance with. We did make money on Credit Acceptance. It wasn't an enormous amount of money, but it was still an investment mistake. So whether we made significant money or not, we still would have sold that position.
That's a great case study, and I think there's another lesson here where it sounds like you've implemented Buffett's rule where you basically only have so many turns at bat, basically, right? And so are those 20 holdings in your portfolio 10 and 10? Is that a hard and fast rule that you can't go over, or do you make exceptions?
Yeah, so I think what you're talking about there is the punch card investing analogy.
Yep.
So you only have a certain number of punch cards in your lifetime, and if you only had 20, you think about them really carefully before you did them. So we have a little bit of flexibility. So we normally say between 8 and 12. It's not a hard rule, but I think if your portfolio gets larger than, say, in our case, 24 positions and sort of 10 watch list positions, so say 30 positions in total, I think it can get a little bit hard to stay on top of all the information that's coming through in that portfolio. Because then I think you start to wonder how well do you know the businesses. And then also I'm just a firm believer in the fact that a concentrated portfolio, having all your eggs in one basket and watching it really closely, aligns very well with how I operate as an investor versus having too much of a dispersion.
Yeah, wonderful. Okay, let's keep on the developed market side. Obviously, you invest in U.S. companies, but where else? Like, what other countries do you invest in?
Sure. So on the developed market side, we also look out towards Asia. So we also have Japan. We do also look at Europe on the developed market side of things. And then emerging markets would essentially be pretty much anything else. So we're thinking that China, Southeast Asia, South America. The only continent where there are investment markets, because we're not going to include Arctic, Antarctica, is Africa. Is the only part of the world where we don't have any exposure currently, but where we would look.
Do you not consider Canada as a developed market?
I would include Canada in the developed market side of things. I would indeed.
Have you ever invested in a Canadian company, or do you plan to?
We haven't currently. We have come close on one, which came close to being a watch list position. It's not for lack of ideas. It's not for lack of decent quality companies in Canada. It's more the fact that once you have your portfolio set, in our case, and we have a minimum investment time horizon, we like to say of 5 years, it essentially means we're looking for one exceptional idea per year. So it's a really high bar that a business has to meet to be able to get there, to be included in the portfolio currently when it's set up as it is.
Does Constellation Software have the same fanfare in the UK? Like, I'm sure like in the circles that you're in is talked about a lot.
Yeah, so I think it's an interesting one because I think that also comes back to the first test for a business entering our portfolio, which is circle of competence. Can I understand this business? And for me, I find serial acquirers an area of difficulty. And I don't mind saying that because I think there's 45,000 listed equities globally. You have to find a way to narrow it down. And I think that a lot of investors get too focused on how big their circle of competence is rather than being aware of where the boundaries are. And for me, historically, I've had problems when it's come to investing in leveraged businesses. And serial acquirers is generally falls for me into that category. I sometimes find the financial statements hard to follow, or harder to follow, I should say. And I guess, and that's funny because obviously that comes from my background where I was a credit trader of financials for banks. No one has a more complicated financial statements than a bank. But that's also fundamentally why we don't invest in banks, because I don't believe that even the CEO of the bank knows what the bank owns. So I think for us, we try to stick within, or I try to stick within my circle of competence. Serial acquirers can be phenomenal businesses. Teledyne has historically been a phenomenal business to have watched historically. I mean, Buffett talks about it as one of the greatest examples of capital allocation over an extended period of time. So they can do incredibly well, but we don't own any currently in our portfolio.
Well, that's great to know. Let's go to the emerging market side. Can you talk about an historical position that's no longer in the portfolio and your discovery process all the way through allocating capital?
Sure. So I wouldn't say, some people describe it as an armchair investor, right? Where you find a great business and you do all the research and then you buy it. And I was historically a bit of an armchair investor. I didn't really see the value of meeting the management team of a business. And that kind of changed when I started traveling and meeting the management teams, especially of our emerging markets portfolio holdings. Because what I found was that you can learn a lot on the ground when you meet the management teams, but I actually found in particular when you meet the competitors for a business that you're considering. So one of the businesses that we owned was called Angel Align, which is essentially it's the biggest competitor to Invisalign, would be the US version of it. So they're dental aligner business based out of China. So we invested in the business before I'd met the management team. And that was traditionally how we'd invested. When we got to, the reasons behind the business, it's clearly a growth market, dental alignment. There's a rising middle class in China and in Southeast Asia that would all like to have nice teeth, the same as they do in the West. And this company had all the patents for 3D printing dental aligner technology to provide it at a cheaper price and faster when you were there visiting the dentist or the orthodontist. So we felt that, and they also have the largest market share and growing. So we felt that they had not only growing margins, but growing market share, a clearly dominant position in the market. It was clear that there weren't going to be any entrance from the West into China. It was more likely because of the laws of entering China, full stop. But it was more likely there could be domestic competition. So when I went and visited China, I went and visited who I'd identified as sort of their 2 or 3 competitors. And I'd been led to believe that Angel Align had almost an unassailable market share. And what was interesting was before the visit, we'd already seen that their revenue numbers were not growing as fast as we thought they would be. And then when I got there on the ground, I found that there were a lot more potential competitors to their business I could meet than I'd actually anticipated. And what it turned out was that actually, although they do everything I've said before about Angel Align's business is correct, what you can't tell from the outside is actually the patents on the technology that they had they were finding were not enforceable within China in the healthcare sector. So I think that was an example where it was a mistaken investment for us because actually we didn't understand the investment well enough because we didn't go and put boots on the ground in advance by meeting the management team and talking to the competitors directly. Because the information that you can gather when you're there on the ground can actually be a lot more revealing than what you can learn from just reading or transcripts of interviews or even speaking to competitors through different call services and investor services. When you go there and meet them and you visit the businesses, you can learn a whole different perspective. So now within our 250 question checklist, we do have a checklist point, which is around patents, which is, are they categorically enforceable in the local jurisdiction within which this company operates?
This is wonderful. You obviously read up on all of Philip Fisher's writings, right, and the scuttlebutt approach early on. And I just love to see that you implement that approach. Are you as bullish on China as you were last year?
So I wouldn't have said that we're bullish on China. I would say that we have found pockets of value within the Chinese market where we think that the equivalent business outside of China would be valued substantially higher. But by substantially higher, I mean that there is more than just a China discount on that stock trading currently. And we found a couple of positions where that is the case. When we launched our portfolio, we didn't have a significant amount of China exposure, which I would define as sort of 10% of the fund. That has changed this year. So we've entered a couple of positions in China this year. But I'd say that within emerging markets in general, we're drawn to the countries where there seem to be more macro problems. And what we like to try and identify there is a beaten down market where there are companies where the fundamentals are still phenomenal. An example of that would be Turkey so far this year, where all the politics there that are clouding investors' judgments. We're seeing capital outflows from the country, and actually we've identified businesses there where when the lira depreciates, the business does better. An example of that would just be a simple export business. As long as their costs are in lira and they're exporting in euros or dollars, if the lira is depreciating, these guys are making more money. It's as simple as that. So there are always businesses and there are always opportunities in all parts of the market, especially where other investors fear to tread.
And just to get a better idea of how you invest, your philosophy, if people go to your website, the very top of your website, there's a definition of perception, and rooting in the Latin origin word perceptio. Why is that so important to you, Ardal?
So we've got a little bit further down on our homepage, we have a painting. There's a painting there. It's by the Belgian artist René Magritte, and that for me captures what perception is, because the definition of perception there, which is the ability to review, or as we define it, the ability to review all publicly available information about a business and project forward a different conclusion, is kind of shown in that painting. So in that painting, the artist is pictured seated, and in front of him there's an easel, and on his left-hand side is a table with a stationary egg. And the artist is looking at the egg, but then on the easel in front of him, he's got a fully grown bird in flight. And that, I think, visually captures, they say a painting or a picture can be worth 1,000 words. That picture for me captures the essence of what we do as an investor, how our fund operates, our investment philosophy, which is that we believe that we are able to review all of that publicly available information and project forward a different outcome or conclusion from what the market has necessarily been seeing.
How have you developed your ability to be more perceptive over time? Tell me about the inputs, the lessons learned, and everything that have helped.
So I think actually it comes back to the beginning of our conversation when we were talking about childhood. I think there's a few things in common that very successful investors have. And I think, one of them is a contrarian mindset. Because to differentiate yourself from the market, you have to be doing something different. It's as straightforward as that. It doesn't mean to be a contrarian for contrarian's sake. So if everybody's buying something, you shouldn't buy it. But what it also means is that if everyone's selling something, there might be good value there. Yep. But your holdings have to be different from the market to differentiate yourself from it. So that would be the first point when it comes to perception. And I think that willingness to be lonely, to take a position separate from the crowd, is really what allows us to have a differentiated perception. Because if we're looking at the same thing everybody else is looking at, it's going to be hard to have a different perception. For example, Apple, it's covered by countless analysts across Wall Street. It's commonly held across everybody's portfolio. It will be hard for us to have a different perception of the outcome of the Apple investment at its current market cap of roughly 2.5 to 3 trillion, compared to a less well-known business operating in a market where people don't really want to invest at the moment because they say there's too much geopolitical risk. That allows us to actually take a step back and be like, well, we're bottoms-up stock pickers. We don't really care about the geopolitical risk short term. In the long term, we appreciate what's happening there, but we would want to identify a business, if I go back to the Turkey example, where even if the geopolitical risk continues or increases and the Turkish lira continues to fall, actually the businesses we're looking at there will benefit. So for me, perception really means being separate from the crowd. And the flip side of that is focus. I think it allows us to focus on areas of the market and not be swayed by the crowd. So it's a contrarian streak and focus. I'd say it's the marriage of the two.
That's just great. And then later you named your book, The Perceptive Investor, of which I have a copy. People can go out and buy it. You released it in February. What compelled you to write the book?
That's a really interesting background on that one. So when it came to launching the fund, I thought it would be very useful to write down our investment philosophy. And I have a library at home of roughly 500 business books on biographies, investing, etc. And whenever I read a book, I've always got a pen, I've always got a highlighter, and I'm always looking at different sections of the book. So what I thought I would do is I would sort of amalgamate all of those sections from all of those books into one document. Yep. And then essentially divide it up into different sections and provide my own thoughts on how I thought we would manage things. So, for example, there'll be a chapter on risk, there'll be a chapter on capital allocation, there'll be a chapter on buying, a chapter on selling, etc. And that was essentially the genesis of the book publication. It was an internal document, and a member of my team actually came across it and said, "Oh, this reads very well." And I said, "Well, I hope it does, because it's our investment philosophy." And I had a chance meeting at a dinner with a publishing house here in the UK, and I submitted just a chapter from a section of the book. I sent it to him, and he thought I had a voice as an author. He said number one, and he said number two. When he looked on Amazon, he saw that almost every other book had been written by somebody who was 60 plus in terms of age when it came to investing. And he therefore thought someone in the 30s writing an investment book would be a differentiator, because the publishers really want to publish a book that's going to sell some copies. And as a less well-known author, there's always a challenge there. So that's essentially the genesis for the book. Which is, I really believe that you don't fully understand something until you try to help somebody else to understand it. So by going through my investment background and our entire investment process and philosophy, I found that I had a better understanding of how it is that we do what we do.
And what are the key takeaways that you want readers to take away from the book?
So I think that, to your previous question, I think we're all on our own path when it comes to investing. Yeah. And I think that your path is determined by your life setup and your circumstances, but you do also have some control over it in terms of what your passions and interests are and where your curiosity lies. So my advice is always to follow your curiosity in life, because I find that it will tend to lead you in a direction that is of benefit to you over time. So that would be the first point, that there's no guaranteed path to success in investing. I think there's a lot of wrong ways to do it. And I think that that's what I like to highlight in the book, that there's countless ways not to do things. And if we can learn from the mistakes of others, that can definitely be our advantage, because we don't have to fail and do everything ourselves. It's also a lot cheaper, as Charlie Munger would say, to learn from the mistakes of others than have to repeat everything yourself. And the second one is to find a way of investing and living your life that aligns with you and your core principles. Because, for example, for me, when I was working at the banks, it became very clear to me very quickly that I would not be a good trader. My mentality is just not suited to day-to-day market making of bonds or equities or anything else, actually. my
So what's that
temperament,
mentality? Like, what is the trader mentality?
I think the trader mentality it's much more short term. It's much more rapid fire. It's a lot less considered. You know, you're trying to make hundreds of bets on the hope that you're right on 51% of them, and actually you're making a little bit more money on the ones you're right than the ones you're wrong, and therefore you're profitable at the end of the year. And you're constantly fixated on your P&L, moment to moment, day to day, week to week, month to month. And in fact, your compensation is annual. It's at the end of every year, this is how much I made, and this is how much I get paid. Whereas for me, with my DNA, with the way that I invest, it's I want to know what the business is doing 5 years from now. I'm much less interested in, quarterly reports don't hold very much weight for me when businesses report, because A, they're not audited, but B, very little changes. Having run a few businesses myself, even small ones, the business doesn't change very much quarter to quarter. And the bigger the business, the slower the change. Therefore, we're looking at annual changes over time. So that long-term mentality is core to who I am as an investor, but also as a person, how I conduct myself. And therefore, that's why that long-term concentrated value strategy aligns with me. But that doesn't mean it would align for somebody else. And I think it's really important that however you decide to invest and however you decide to live your life, it's congruent with who you are as a person.
Yeah, so true. That being said, though, like you're a long-term investor. You're looking for long-term value in companies. Do you ever initiate positions based on, let's say, a special situation, a catalyst that's coming up? Have you ever used that framework to initiate?
So not in our current fund. I would say that the only catalyst we'll look at would be for watch list positions. So that would be where maybe we've identified what we think will be a future exceptional business, but maybe it's not profitable at this moment in time. So one of the key metrics for us to be a full holding within our portfolio, which means roughly a starting position of between 4 and 5% of AUM, means that the business really does have to be profitable. It has to have quite a lot of footprints in the snow. Yeah. So immediately then, if the company has recently IPO'd in the last few years, if it's not profitable, if it's going through a period of short-term distress, those might be reasons why we would enter it as a watch list position, which you might define as special situations. Yeah. And then once we see that it's emerging from that, either it's got a couple of consecutive quarters of profitability or annual profitability, or that near-term headwind is clearly reducing, we could then look to increase it to a full position within the portfolio. And we do have a current holding in our portfolio that did start as a watch list position. And the reason for that was it wasn't profitable, and it only had 2 years' worth of public markets history. And that for us was just not enough to have conviction that going forward, this would be an exceptional business to start it as a full position. And what happened was during the 3 years of operation of our fund so far, that business has become profitable. We've seen that the growth trajectory is possible there. And so last year we upgraded it to a full position in the portfolio.
Yeah, that's just great. A lot of my viewers, Ardal, are in the U.S. and Canada. But if we look at the UK and the rest of Europe, who's influenced you? Like, who are the fund managers who've been influences? Yeah,
there's always so many investors that you can mention, in particular from the US and Canada, I find.
Oh, yeah, exactly.
I guess that's probably because they dominate financial markets in terms of assets under management and the like. But in the UK, I'd say one of the people that I most admire is Terry Smith, who runs Fundsmith. So for those that don't know, Terry Smith was actually an entrepreneur himself. He was essentially the founder and CEO of several large financial related businesses before he went on to found Fundsmith. And Fundsmith is essentially they're concentrated value investors, but they're very focused, I think, on what you might describe as the mega cap and larger mega cap space, just because of their fund size. I think at last count, they had something like 20 billion of AUM. But what I like there is he's incredibly transparent in terms of fees. His focus is on charges investors the lowest possible fees, which I think is a really admirable quality. The second one is he has almost all of his money invested in that fund, which I also really appreciate. He's very transparent with the investment strategy. He's very long-term orientated. And I find that those things align very well with me as an investor. And I think I also really enjoy reading his annual letters, which are all available on the Fundsmith website. So anyone that hasn't come across Terry Smith, I think he's definitely worth a look, because even if you don't invest with him, he's got a really acerbic pen, would be how I describe it. So when he writes about companies, they pay attention because he's usually a very large shareholder. And he can be quite critical of management and current things going on in the market. So you get a bit of a laugh sometimes when you read parts of his annual letter.
Terry Smith is just phenomenal, and I believe people can go onto the Fundsmith YouTube channel and watch the annual general meetings, which are great. They're all public there. Have you ever met Terry?
So I actually sent Terry a copy of my book, which he thanked me for, and I have referenced him in one of my annual letters. So I have an interesting anecdote on that one. So we write our annual letter, obviously, at the start of every year. So I referenced Terry in one of my annual letters. So I sent him a copy in March of that year. In December of that year, I got an email from Terry saying, "Dear Ardal," it was very short, "Dear Ardal, really enjoyed your annual letter. Sorry it took me so long to get back to you, but I had an enormous pile of paperwork and I only get to it between Christmas and New Year. Best, Terry."
That's great. He's a celebrity in the UK, and I completely agree. I've been following him now for probably 10 years. He's just great to listen to. A lot to learn. And while he invests in the world of large cap and mega caps, it sounds as though you're investing in the mid cap world. Is that right? Is that a fair assessment?
I'd say we're small to mid cap. So
Okay.
the median market cap for us is probably around that $6 billion mark. But I think that's probably swayed by, we have two mega cap holdings. And I'd also say that typically our developed market businesses tend to be, give or take, probably double the size of our emerging markets holdings. Mainly, it's usually due to the development of the markets themselves. What is a small cap in the US can be a large cap in a developed market.
Yep. Interesting. What is the small and mid cap advantage, and why do you invest in, I guess, smaller companies for the viewers?
So the main reason for us is it's not necessarily. So I think a lot of people say, "Oh, they're less covered. There's more opportunities. You can have it easier to have a differentiated view." But actually, for me, it's something more fundamental than that, which is that one of the things we really are focused on is owner-operated minded management. And one of the things you can find in the small cap and mid cap space is where the management team of the business founded the business, or and that's whether it's first generation or second generation, and also they tend to still be involved in the business. And that for me is quite a key differentiator, because as a business gets bigger and bigger, you get more and more external financing. In general, as a shareholder, you get diluted, or the management team or the original founders leave and they sell down their equity stakes over time. And in that small to mid cap space, we can find businesses where the management team still are the original founders of the business, and they're really, really aligned. And the reason why they still keep the majority of their net worth in the business, despite the fact that they've probably been offered countless times and countless opportunities to diversify, is because they believe that business is the best store of their wealth. And that is very attractive for me as a long-term value investor. I want to be aligned with people that have conviction in their business. And we mirror that in our fund here at Loh-Gronager Partners, where the management team is the second largest investor in the fund. Because again, we want alignment, long-term alignment with our investors. So I kind of think that we treat our business, which is our fund, very similar to how we look for our portfolio businesses within it.
Completely agree. Going back to Terry Smith and paying homage to Monish Pabrai, cloning. Have you ever cloned, the likes of, for example, Terry Smith, any of his positions, or perhaps any other mid cap or small cap investors? Is that part of your tool set?
Yeah, so I think that there's clearly lots of different ways. I mean, I referenced before there's 45,000 listed equities globally, so you need to have some sort of filter process, right? And there's various different ways of going through that. So I don't know whether you can see over my shoulder here, there's a green book. So that is one of the original Moody's manuals. So they are the books that Warren Buffett used to use to pick stocks. And essentially it goes A through Z of all the listed businesses, and you used to go page by page through them. So you could do that today. It would just take you an incredibly long time. So a lot of people today will use screens or filters. So they'll screen the universe by geography or by sector, or by financial metrics like price to sales, price to book. I don't find that those sort of methods are always the most helpful, because they're the most rough. I normally find that idea generation can come from more spontaneously. So it can come from attending investor forums or industry or investor conferences. I find that just by reading the news or media in general, you can come up with interesting ideas that take you down a rabbit hole. And then very rightly, as you pointed out there, what Manish Pabrai calls cloning is a really, really good way, I think, of looking at the holdings of other exceptional investors and trying to reverse engineer why they might own those businesses. And then obviously within that subset that you do successfully manage to reverse engineer, how many of those sit within your circle of competence? And I think that is also a good way of trying to source new investment ideas.
Yeah. So we see the Moody's manual now, the green book behind you, but also just above your head, the frame there. What's in the frame?
So this is our one aspect of our fund is very much focused on sustainability. So as a long-term investor, we really do care that our businesses, so some people might define this as ESG, we call it sustainability because ESG is exactly sustainability. And I think when people talk about ESG, it's the wrong way round. It should be G first, which is governance. Because why you would want to invest in a business with poor corporate governance doesn't make any sense to me. Why you wouldn't want a business that invests for the long term, whether it's in employees or the local environment that it works in, is also doesn't make sense to me as a long-term investor. So ESG is a natural component of being a long-term value investor. And that part of our strategy is run by Dr. Christian Jespersen. So he, alongside being our chief engagement officer with each of our portfolio businesses, is also a tenured professor at Copenhagen Business School, where he specializes in board diversity and sustainability. So the picture you can see on the background is also on our website. And that's a river and some of the trees in Scandinavia. Christian is based in Denmark. And it's just to remind us there that our focus is very much on the long term.
That's just great. And you're Danish background, right? Born in UK.
Yes, exactly. So I was born in the UK, but I'm half Danish myself.
Wonderful. I'm half Swedish, so we definitely come from the same area there. Now, governance is so important. I want to get your opinion on this. Chairman and CEO, same person. How do you feel about that? Should these be separate people for these very crucial roles?
It's interesting because I find that question is only predominant in North America in general, because it seems to be in North America where they'd like to amalgamate the two roles into one. And actually, I don't know whether you follow Nicolai Tangen, who is the head of the Norwegian Sovereign Wealth Fund, so arguably the world's biggest investor. They're quite vocal in the fact that they think that the chairman and CEO roles should be separate.
I agree.
On his podcast, he does ask some of the CEOs of some of these big US businesses that they own shares in. For example, he'll interview Jamie Dimon, and he'll say, Jamie, on this point, and they'll agree to disagree. I can understand why in certain circumstances that role could be combined, but I also think that sometimes a diversity of opinion that ultimately the CEO, in my view, should be accountable to the board. The fact that the CEO is the head of the board as chairman doesn't ring true to that, just on a very simplistic level. And I think sometimes we need to look at things as simply as possible rather than overcomplicate them with all the factors that we could come up with why the roles should be combined. I think we should start from the basics, which was, well, if you're going to have an independent board of directors, you've heard it straight away there, it should be independent. And the CEO being the chairman of the board, I think compromises or could compromise that independence. And that's one of the reasons why we have a big focus when we're looking on governance. We want to see a board that has independent directors, especially where the business is founder or owner operated. If it's first generation, what we can often find is the board might be stacked with friends of the founder. And that's never normally a good sign. And what we like to see is a progression over time from that. And normally it happens when you see a first generation owner transition to second generation leadership. Because in general, the owner has made significant wealth. And in emerging markets, they then look to or normally educate their children abroad, whether that's in the US or in Europe. And what normally happens is the son or daughter will come back to the family business after being educated abroad and potentially working for a large business in the West. And they'll essentially come back and they'll say, Dad, with respect, you want me to take over this business, but, why do we have three of our uncles on the board that don't really have any business experience operating in this area? Why don't we have, an audit committee, a compensation committee? Why don't we have independent directors? And then they'll explain why. And often, if you're an external shareholder in these businesses, you can't tell the CEO how to do their job, especially if they're the majority shareholder in the business. But their son taking over certainly can, or daughter. And what we find there is that conversation usually goes very well, because the father all of a sudden comes to the conclusion, goes, if we have an independent board of directors, we'll then qualify to be included in various indices where board and sustainability and governance is important. So our share price might increase over time. We might have a more stable shareholder base, because those people are focused not on short-term gains, but on long-term evolution of the business. So those things can sort of go hand in glove together.
It's just so crucial, and it's not talked about enough, right? You absolutely need checks and controls in a business. And I love how you've implemented that into your checklist, basically, right? The process to uncover some of these outstanding companies that are sustainable. Let's talk about um, a coffee date. Let's say, Ardal, if you were to pick one investor, alive or passed on, who would that be for a 1.5 hour coffee?
Really good question. I would pick John Maynard Keynes. So Keynes, obviously the celebrated economist, but what might be less known about John Maynard Keynes is he also ran what was known as the Chest Fund at the college, Queen's College, I believe it was, at Cambridge University. And the reason why I would choose him was he essentially went through the whole spectrum of investing to end up at concentrated value investing, even though that's not what it was known at the time. Mm-hmm. So he started by trading globally. He was trading interest rates, commodities, bonds, and he was trying to have views on the macro, views on the market, trading in and out. And he developed over time, he realized that actually he had no edge in that game and had a very, very poor performance track record. But he had the insight and the ability to realize, hey, if this isn't working, I should try something else. And he ended up deciding that his next level was owning lots of different businesses. And what he realized there was actually his returns also weren't great, because he really didn't understand what was going on all the businesses. So again, another step of evolution to end up being a concentrated value investor. And what I think that progression over time would be fascinating to learn, going from being what was essentially a macro trader all the way to being essentially a concentrated value investor. And then the performance that he had for the chess fund at Queen's College, Cambridge, was exceptional, especially when we look back at historical track records. So I think, and also he lived through a very interesting period of time. So I think to get his insights on those sorts of things would be fascinating.
That's super interesting. Yeah, people just think that he's the economist, and they won't read up on his lessons on investing. But I agree. I've also read his teachings. Now, a question just popped into my mind, and I think it's crucial to ask you is, I want to know about your decision-making process when it comes to, let's say a position that you made last year, and you're thinking about increasing your stake in that position in the portfolio. What goes through your head? Do you indiscriminately average up? The business continues to do well, or do you wait for maybe a minor setback? Perhaps they didn't meet expectations. There's a drawdown in stock, and that's when you add. Like, how do you add to positions, and why?
So in general, we have a portion of our portfolio which is our sort of cash management part of our strategy. So that is essentially where one of three sources of funds to add to a position. The second one would be new AUM coming into the fund, and the third would be dividend or interest income accumulating from the portfolio. So those would be sort of three sources of income. For us, we have a very straightforward portfolio structure, which is, as I outlined, sort of 10 by 10, developed markets, emerging markets. So each position starts with a roughly 4% weighting, because we also have our 1% watch list positions. And I'm a big believer in the fact that the majority of the gains of our fund over time will come from the winners. And it's allowing those winners to run and compound over time. So we have no issue whatsoever with averaging up. I'd also say that over a roughly 3 to 5 year investment time horizon, if a business is underperforming, but the fundamental share price wise, but the fundamentals remain the same, we have no issue whatsoever with averaging down either. So we're happy to do both. And generally what we do is we don't isolate on one position. So if new AUM comes in general, we'll dollar weight it across the whole portfolio. Okay. So that way we're adding to our winners, and we're also adding to our losers. And the reason behind that is essentially that from any 1 year to the next, I have no predictive ability as to which business is going to perform the best or the worst. All I believe is I think we've assembled a portfolio of exceptional businesses that over the long term will perform incredibly well. But one of the things we've learned from the teachings of Peter Lynch is that actually we're going to be wrong a significant portion of the time. We just don't know when. So humility is a key part of the investment process. I don't think I have any ability to predict which of our current holdings is going to be the long-term best performer. So on that basis, I shouldn't be allocating more capital or less capital to any individual position because I don't know ultimately which one will win. And there's an interesting piece of research. I don't know whether you've heard it. It's by a gentleman called Lee Foreman Shaw. So he wrote a book called The Art of Execution. So he was a portfolio manager at a firm called Quilter Asset Management. And essentially he had sort of 10 portfolio managers underneath him. And one of the things he realized was each portfolio manager had what they would say were their best ideas. So as the boss, he had an idea. He said, well, why don't we start a fund where I take the best single idea from every portfolio manager and put them into sort of what he called a super fund. And then obviously that would perform even better than the 10 individual managers. So he asked each of the managers, please give me your best idea and I'm going to put them in this fund. So he did that. We got out external capital, started this fund, and that fund underperformed all of the fund managers. And the reason for that is actually really straightforward, which was the fact that each of the portfolio managers could only identify their best idea based on performance after the fact. They could never predict it before it had gone up in value. So on that basis, what I've taken to heart is if we can't know pre the event which business is going to do best, we should treat all of them as if they have the potential to be the best performer. And that's the humility of adding both to our winners and to our losers, because over time, only then will the winners become clear.
I love that. I haven't heard of that study, but that's just great. I got to read up on that one. What are your ambitions, Ardal, for the fund, for the firm? What does success look like, let's say, in the next 10 years for you?
I think for us, it would be the fact that we didn't stray from our goal, which was to be a single fund focused business, whereby we have the right team today to grow that fund to significantly in excess of the size that it is today, while staying true to our investment goals and principles. So that is always treating our investors' capital as if it was our own capital, always remaining focused on delivering exceptional long-term performance, always investing in businesses where we think long-term it's going to be better. We're not just making money, but we're also making money the right way. So I think that's how I envision the future. I don't envision necessarily growth in number of people. I don't necessarily envision growth in terms of office space, but I envision growth of the business and the journey itself, but by staying true to our principles for the entire period.
Yeah, which is great. You've been invited by Guy Spear to give a talk at his event, which is wrapped around the Berkshire annual meeting, which is awesome. So you'll be traveling down to Omaha. Can you give us a sneak peek of what you'll be talking about?
Yes, I can. So, as you kindly alluded to earlier in the conversation, so I've had a book published called The Perceptive Investor. So it was good that we got to go deep dive into what perceptive investing actually means. Yeah. And my talk at ValueX Berkshire is going to be on about giving back. So all the proceeds from the book go to the Financial Times Literacy and Inclusion Campaign, which is a charity run by the Financial Times. And this is my attempt to begin giving back at an earlier stage. Mm-hmm. And I think we can all learn from the greats about how to do this, whether it's Bill Gates or whether it's Warren Buffett signing the Giving Pledge, whether it's Guy Spear hosting an annual charity lunch, and that's how I came to know him, by winning the charity lunch auction, or in our own way, giving back, whether that's our time or whether it's with money.
Yeah, this is just great. And I wish you the best for that talk. I'm sure it's going to be awesome. I'm going to watch it. I'm sure it'll be up on Guy Spear's YouTube channel when all is said and done. Yeah, this has been great. This is awesome, Ardal. Have a great day and talk soon.
Fantastic. Thank you so much, Robert. Really appreciate
Cheers.
the time.
Bye.